Hi everybody. In this series of study guide lectures, we'll practice writing journal entries and making adjusting journal entries similar to the examples provided in Chapter 2 in your textbook. None of these business transactions, journal entries, or adjusting journal entries should be difficult or surprising to you, as they were all covered in Accounting 301, which, as you know, is a prerequisite to this intermediate accounting class. Please do the following two things before completing the Chapter 2 study guide exercises. First, thoroughly read Chapter 2 in your textbook and work some of the exercises provided in the chapter. You will need a thorough understanding of the chapter, as these study guide videos will present only some of the chapter highlights. Second, download the Excel file embedded in the Exam Number 1 Study Guide Tips and Instructor Study Guide Lectures page in the Canvas modules so you can complete the worksheets as you watch the video. You will get the most out of these study guide examples if you will please take time to pause the video and prepare the calculations and write journal entries. Then start the video again to check your answer. If you got it right, you'll feel great. If you didn't get it right, that's okay for now. Now is the time to learn from your mistakes so you don't make the same mistakes on the upcoming exam. There will be a detailed analysis of the correct answer that should provide an opportunity for you to understand your error and learn from your mistakes. Let's begin writing journal entries for a corporation that provides consulting services to its clients. It also sells merchandise inventory. This company uses the Perpetual method to account for its inventory. And we're going to take a bit of a shortcut when recording these journal entries. I have provided a detailed chart of accounts. Instead of writing account titles, you will write account numbers similar to this example given to you on the worksheet. Please be sure to utilize the following procedures as you write your journal entries. Always, always, always list debits before credits as you journalize each business transaction. Under the Perpetual inventory method, 2 journal entries are required to record the sale of merchandise inventory. The first journal entry records the sale with a debit to cash or accounts receivable and a credit to sales. The second journal entry records the cost of sale with a debit to the cost of goods sold account and a credit to merchandise inventory. There must be at least 2 accounts affected by every business transaction, but compound journal entries can involve 3 or more accounts. And for each journal entry, debits must always equal credits. Okay, now that we know the ground rules, let's get started. On August 1st, 20X1, the business wrote a check for $7,200 for 12 months office space. Well, we spent the cash, so we know we're going to credit cash account 101. We cannot debit rent expense because the matching principle says you record expenses in the time period that you incurred those expenses, and we have not, on August 1st, incurred 12 months worth of office expense. So instead of debiting rent expense, we're going to debit an asset account called prepaid rent. So prepaid rent is account 128. Debit 128. Always write debits first. For $7,200. Actually, I'm in the wrong line. And credit cash, account 101 for $7,200. Notice that I've given you only one column to write your account numbers. Debits are on the left, credits are on the right. Notice that I wrote the account number 128 that I'm debiting to the left side of that column, and I wrote account number 101 that I am crediting to the right side of that column. Let's do the next one. On September 1st, 20X1, the company purchased $1,500 in supplies and $6,300 in equipment on account. The company uses the straight-line depreciation method and expects the equipment to have a useful life of 7 years. Well, at September 1st, we're not going to record any depreciation. We're going to wait and record depreciation at the end of an accounting period. So this is information you're going to need later, but you do not need this information right now. In this business transaction, we acquired supplies, which is account 126. We also acquired equipment, which is account 167, and we did not pay for it using cash yet. Instead, we're promising to pay for it later. So the journal entry looks like this. Debit supplies, account 126 for $1,500. Debit account 167 for $6,300. And credit accounts payable, account 201 for the full amount of $7,800. On September 25th, 20X1, the company sold merchandise inventory to ABC client for $9,300 on account. The inventory cost this company $5,580. You're given the amount of the sale and you're given the amount of the cost of sale. And remember that there are two journal entries. Record the debit and credit required for the sale, then record the debit and credit required to record the cost of sale. Why don't you pause this video, write those two journal entries, then start the video again to check your work. And here are the two journal entries. To record the sale, we sold it to our client on account, so we didn't get any cash. Instead, we have accounts receivable. Debit account 106, $9,300. Credit sales, for account 401, $9,300. Then record the cost of goods sold by debiting cost of goods sold, account 501, and crediting merchandise inventory, account 131. Debit 501, $5,580. Credit 131, $5,580. On October 1st, the company borrowed $300,000 from First Bank. The note they signed requires the entire $300,000 principal plus 8% interest to be repaid on October 1st, 20X2, 1 year later. As of October 1st, there is no interest on this note because that's the day they borrowed the money. So this is information you're going to need when we write adjusting journal entries, but it is not needed to record this business transaction in the form of a journal entry on October 1st. So go ahead and use your chart of accounts and record this journal entry for October 1st. Then start the video again to check your work. On October 1st, when the company borrowed $300,000 from the bank, they received the cash from the bank, so debit account 101, and they signed a note payable agreeing to pay the $300,000 back with interest in 1 year's period of time. So we're going to have to credit the liability account, notes payable, account 251. So debit 101, $300,000, credit 251, $300,000. Well, this video is already getting a little bit long, so I'm going to end this video, and in the next study guide video, we'll continue writing the journal entries for this company. We'll start with the October 8th transaction in the next video. See you next time.